So, Leland, you've just had your fourth quarter report published. Where does your research and the official numbers part ways?
Well, it's pretty interesting. If you look at China Beige Book data next to official data, next to private data like the PMI, they actually look very similar. But where we break from official data is the intensity of the recovery. We are seeing a recovering economy. We are seeing an economy that's recovered better than just about anywhere in the world. But from a year-on-year standpoint, we are still seeing them not up to 2019's level yet. So the economy has gotten better month over month and quarter over quarter, and it's going to continue to improve into 2021. But we're not seeing these sky-high levels of year-on-year growth that Beijing's preparing to announce. So it's a major difference. Good recovery, but let's not get ahead of ourselves.
Well, the export numbers for China have been extremely impressive. Imports much less so, however. What is that telling you?
Well, I mean, that's the real mystery here. If this is the world's strongest major recovery, why are they not importing more from all these all these countries around the world that badly need to export to it? That's been that's been the real question. China has had an export-led economy. It's been a supply-side recovery. When you look at where the demand is right now, we're actually seeing very, very moderate, very modest demand domestically. I mean, what they're doing is they're exporting much more, and that's where they're getting their recovery from. So if you were seeing this being a true recovery, a recovery that looks like 2019 or 5 percentage points better than 2019, you would be seeing a more robust consumption culture. You'd see more robust domestic demand. You're not seeing that in our orders data. You're not seeing that in our demand data.
It's also that narrative that's actually led to commodities prices just rallying, right? Some people calling it the super cycle, given expectations that, China will consume all of these commodities. What's the downside of that?
Yeah, the commodities data are fascinating because, back in, May or so, I mean, we saw the commodities rally to take off before it was really in some of the key pricing data. And so there are a lot of things going on in the mainland in terms of building and commodities production. And this has really been going like wildfire for the last several months. But what's happening right now is you're getting a situation that looks a lot more like 2016, where the fundamentals diverged from skyrocketing commodities prices. And where you're seeing that in particular, it's copper firms and steel firms who are doing worse than the third quarter. They're reporting falling sales, falling income. Their margins are collapsing. Much, much worse performance in Q3. But a lot of the time that's because there's key inputs that are going into it that are getting more and more expensive, like, for instance, iron ore. But you're also seeing a situation where speculators are driving up the prices of these commodities, and it's not reflecting actual demand. And the problem with this is you get a situation like early 2016 in which people see this, they think that underlying stimulus is stronger, underlying growth is stronger, and that's where you start getting a problem. We don't understand that these are not fundamentals driving the commodities prices at this point.
The narrative had changed recently when it comes to China's economic recovery. We had focused a lot on all of these stimulus measures coming from authorities, but perhaps lately they're trying to rein in financial risk. Is that what you're seeing on the ground as well?
Oh, yeah. We're seeing tightening conditions, and it's just jumping out of the data in certain parts of the economy. If you look at what's happening to retail firms right now, retail didn't have a very good quarter. They're not doing as well as services or manufacturing or others. But what's very interesting is when you look at retail credit data, the loan rejections were the highest numbers we've ever seen. It was very difficult for a retailer in China to get credit this quarter. And as a result, you're seeing retailers have some real problems. They're not being favored by bankers right now. And a similar type of dynamic is with SMEs. Now, we know how important SMEs are across the economy. If you're a large firm, you're applying more, you're getting rejected less, you can get all the credit you want. But if you're an SME, loan rejections jump just like for retailers in the fourth quarter. So you are seeing tightening conditions. But these tightening conditions are hammering firms that are really needed to be part of the consumption recovery, a more sustainable recovery. You need those retailers. You need those SMEs. You got to get them some capital.
Yeah, well, as Sherry mentioned, domestic consumption intended to be a plank of China's economy going forward. So what were your findings around consumer strength in the context that you were describing?
Well, this has been an overblown story basically for years. But even when you talk about the current recovery, there's been a talk about how the Chinese consumer is back. Look at the services data, for instance. Well, you know what? Our services data was great this quarter. Services was the top performer, and we saw real improvement. But if you break open services, you're looking at the business side of services driving that growth. You're talking about telecoms and IT and shipping and financial services. If you look at the consumer side of this, hospitality, chain restaurants, travel, it's those subsectors are doing much weaker. So it's a mistake to look at our data, to look at PMI data, and see a high services number, and to equate that to a return of the Chinese consumer. We're not seeing that in the overall data, and we're certainly not seeing that when we break it down into subsector components.
What about inflation?
Well, we have a better story to tell than official data on that. If you look at what's happening in official data, they're claiming this booming recovery, and yet you've got all this talk about the possibility of deflation risk. We're actually seeing a much healthier inflation atmosphere. We've seen a recovery economy, and we've seen rising prices. We've seen rising input prices. We've seen rising wages. So it's been going up. Fourth quarter moderated a bit so that you weren't seeing the same level of jumps as we did in Q2 and Q3, but still a relatively healthy dynamic. So we're not talking about deflation risk. We're not worried about that. What we're seeing on the inflation front is actually much healthier than what is being broadcasted in official data.
Bloomberg updated its default data for China recently. Onshore bond defaults hitting just over 19 billion, offshore just over 8 billion. Is there any we talk about this a lot. Are you concerned at all about what you see there?
Well, I'm concerned in terms of the fact that look, you have a lot of dislocations happening, and you've just had a very difficult economic year for the whole world, including China. So yeah, you're going to have some problems across the corporate landscape. But I think what people have to keep in mind is this is a political problem. This is not an economic problem. China needs to suck in more capital from abroad. They need to suck in more investment. They want to make the domestic landscape very attractive, and they will not allow these things to cascade out of control. They'll talk about better debt management and less non-performing loans. But at the end of the day, if you start seeing a lot of defaults and investors get scared, then they're going to shy away from bringing their money in. So you will see continued tightening. They call it deleveraging. It's not deleveraging, but you'll see these type of conditions where they're trying to get the debt levels under control. But when it starts to look like a systemic problem, they're going to let off the gas because they don't want to affect investors' appetite for the country.